In terms of watching the 10-year yield, obviously it's an important indicator. What I've seen over the past several months is, I think, a reflection of a number of factors around the economy. One is clearly additional fiscal support that we saw late last year, and we're, obviously a lot of discussions around that and expectations of additional fiscal support. Also, progress on vaccination here in the U.S. and around the world. So, what I see is the markets, especially the Treasury market, responding to some good news on vaccination and progress there, and maybe reduce downside risks there, and news around additional fiscal support, which should, accelerate getting back to full maximum employment. So, to my mind, we're seeing signs of rising inflation expectations back to levels that I think are consistent, closer to consistent with our 2% long-run goal, and signs of somewhat higher real yields off in the future, reflecting greater optimism in the economy. So it's not, to me, a concern. It's a more of a reflection of, I think, markets' perception of a stronger economic outlook.
John, as you correctly state, real yields are up a bit, but they're still, I believe, negative if you just take a general inflation number and subtract it from the yield. How do you think about when and if the rise in yields becomes something that ends up restricting or putting a brake on economic activity, such that you think it might be something the Federal Reserve needs to do something about?
Well, as you point out, they're quite negative, and not just in the United States, but in many economies that have negative long-term yields. And I do think that reflects the extraordinary economic downturns that countries around the world have seen, and the expectation is going to take quite some time for economies to get back to full strength. It's also in the context of a very low, neutral or normal interest rates as well. As we've talked about before, interest rates even before the pandemic had, kind of the normal level of interest rates was quite a bit lower. So in terms of thinking about this, again, we're, the Federal Reserve, we're very much focused on maximum employment and price stability, achieving a sustained 2% inflation rate, and, achieving a maximum employment. So the context for me in thinking about monetary policy is not so much exactly where the yields are in terms of 10-year yields or other financial, prices, but really about how do we best position monetary policy for success in achieving our goals.
Let's now layer in the discussion, John, if you would, about the coming stimulus and or relief bill, if you will. The idea that there's another 1.5, 1.6, the president's asked for $1.9 trillion of additional federal spending that's coming, which, some economists have described as, pouring gasoline on a pretty already hot fire. If you think about where GDP forecasts are right now, does it worry you that perhaps there's too much stimulus coming down the pike?
Now, the first thing I'm going to say won't surprise you, that's the job of elected members of Congress and the president to decide on fiscal policy, and I'll state a monetary policy. Honestly, right now, the economy is still in a very deep hole. Employment is down by roughly 10 million from where it was before the pandemic. Unemployment is still quite high, and employment to population ratios are really quite a bit lower than we would like to see. So I think right now, the economy has quite a ways to go to get back to maximum employment, and we have a ways to go to get back to our 2% inflation target. So I'm not really concerned about stimulus or fiscal support right now being excessive or anything like that. Really what I want to see is an economy that gets back to full strength as soon as possible, obviously in the context of a sustained 2% inflation.
John, talking about assets in general, the Federal Reserve Monetary Policy Report to Congress today, which I assume you're aware of, talked about asset valuation pressures having returned to or exceeding pre-pandemic levels. I guess that's a euphemism for asset prices being high. How much concern do you have about that and the idea that Fed policy underpins those kinds of high asset prices?
Well, this does take us back to the, very high asset prices we were seeing even last year and before. And clearly, equity prices are quite high. We're seeing quite a pickup in residential real estate prices, and very tight spreads on corporate debt instruments. So there's definitely a lot of indications of very strong asset prices. I do think it reflects a couple of fundamental factors. One is I think that market participants and investors around the world are looking ahead through this year and looking into an economy that hopefully will have a pretty robust recovery and a strong expansion over the next several years, which would support stronger valuations. I also think that we still are in a globally low interest rate environment, even abstracting from the cyclical part of that very low yields on sovereign debt or on treasury securities, things like that, does all else equal imply higher valuations for asset prices. So I think the big drivers, the fundamental drivers, are really kind of optimism among investors to get, the U.S. economy and the global economy is going to have a strong recovery and expansion, and expectations of low rates, well off into the future. And those combined will give you higher asset valuations. In terms of concerns around this, it's one thing to say that the fundamentals kind of tell you that asset prices should be somewhat higher. Obviously, the concern would be if that gets out of control or we see really strong imbalances resulting from that in terms of business or household or behavior by businesses or households or financial institutions. And there, I actually don't see really the evidence for that.
Shepard Smith here. Thanks for watching CNBC on YouTube.